From on again, off again tariff talks to bond market concerns about the big, beautiful bill making its way through the U.S. Congress, there are certainly lots of factors weighing on the markets these days. So how should investors navigate these highly complex landscapes? Michael Craig is Managing Director and Head of Asset Allocation and Derivatives at TD Asset Management, and he's here to walk us through the risks and opportunities and how he thinks. Hello.
Hey, Kim, how are you doing?
Doing well. I think I just almost want to start there and just say, you know, the markets have roared back up, equity markets have roared right back up, and often in I'll say even like the semis and the tech, and you know, we've seen lots of things move back up. Bond markets, I think, are a little more, less sure, perhaps, of where we're going. How do you think about where we are right now in the equity and bond markets?
So we still have a modest overweight in equities. We've started to cover a little bit of our fixed income underweight as yields have risen quite high. There was news overnight in Japan about them withdrawing some issuance because the Japanese market's actually been the bond market's actually been ground zero for the move in yields, and so bonds feel like this move higher is probably near the end. If not, we'll have a little bit of a rally. But we're still going back and forth between kind of, is Trump in a good mood today or is he in a bad mood today? And, you know, this constant kind of debate or negotiation in terms of what trade looks like in the years to come. I think with the tariff side, we're probably getting to the end of the tariff story. But make no mistake, this isn't the end of what they're trying to do and accomplish and to remake what America looks like. And what I find what's really interesting is the reaction amongst other foreign capitals in terms of what they're going to do. I find that quite fascinating, and for us, it is starting to open up opportunities to look for investments in other jurisdictions outside of the U.S.
Can you tell me a bit more about that? What's fascinating?
Well, you know, we've kind of, you know, look, the world right now is selling their wares to the U.S. consumer and taking those dollars and reinvesting them into the U.S. financial system, whether it's in the treasury market, equity market, private markets. I think this is about to change. I think that foreign capitals, Canada, Europe, Asia, et cetera, are going to look for ways to stimulate growth that isn't as reliant on the U.S. They're going to be looking to become more self-sufficient. You heard it in the throne speech today. Many of the things that Carney or King Charles talked about was leading to more growth in Canada.
Production independence. Right?
Production independence, what have you. And so this is very different than what we've been used to, and is going to lead to, I think, some indigestion in markets and other opportunities. And so we've moved more capital outside of North America. We've moved more capital to Canada, trying to really diversify our equity mix. There's a big valuation gap still persistent. And I think this is going to lead to better growth prospects in the world ex-US when we look back in a couple of years.
Is this stagflationary? I think that's what people worry about.
You know, it's not. I think that's, you know, near term might be the case, but you know, the stagflation is weak growth, high inflation. So weak growth we get from uncertainty, which I think on the trade side is going to abate. And you saw the U.S. Conference Board show much better expectations of the current situation today in today's data. And on the inflation side, whatever tariff rate comes through, it's a one-time hit. It's like a tax. It's not something that's going to lead to more demand over supply continuously. So I think there's a short-term stagflation hit. I don't think stagflation is going to be in the lexicon of markets in 6 months from now.
Can you talk to us a bit about just yields in terms of what we've seen with the 30-year and the 10-year, and you know, people make much ado about it crossing certain thresholds like 5% and what that means. You know, does it mean what we think it means, or does it mean something different?
Well, sometimes when you see higher yields, it's a reflection of better growth.
Yeah.
That would be a mistake. In the U.S., there's been, you know, some issue with deficits. The U.S. is having to raise an extra $2 trillion a year. And, you know, if you take what I just recently said and kind of take it to the next level, it's if countries now, if there's more of a global demand for capital, you know, if Canada wants to do infrastructure and Germany wants to do defense, et cetera, then the cost of capital's got to go higher, and that's going to be reflected in the bond market. So I think the press is really hyping up the U.S. deficit story, and it is a problem, no question. But I think what's much more interesting is that countries are now starting to look at that capital, that excess savings in their own country that's being exported, and saying, we'd like some of that because we have our own objectives. And so I don't see a precipitous increase in yields, but I also think that Canadian 10-year rates shouldn't be at 3%. They should probably be more like 3.5% if we're able to raise our growth profile like the Liberals want to do. So I with fixed income right now, I mean, yields are actually pretty attractive. The movement in yields is uncomfortable, but the all-in yield you're earning from coupon is not bad. But we're going to a level where investors are demanding higher rates, and I don't think that we're going anywhere near where we were in the previous decade, back to 1% yields. I think those days are over. So if you're hoping for this big drop in yields, if you're looking to refinance, I would caution against that.
What does it mean for U.S. dollar as reserve currency? This comes up, every 5 seconds.
There's a tactical answer and a strategic answer to that. Tactically, let's just say the next 6 weeks.
Yeah.
The market is very bearish, the dollar. And so today it had a bit of a move. I wouldn't expect to see a bit of a lift in the dollar. But once we get through that strategically, I think all roads lead to a weaker dollar. I just look at this setup and everyone's talking about it. I don't think anyone's positioned for it. And so, and some of the things, as we move away from trade, there's no chatter within the U.S. administration about taxing assets in the U.S. There's a lot of tax treaties that we don't pay tax on private or public investments in the U.S. They're now looking at that. And that is the other side of trade. I mean, there might be a trade imbalance, but it's also a capital imbalance. And if that's the direction they go, dollar's going a lot lower. And I would caution investors, like we've had a bit of a free lunch last many years. Last 10 years, about 4% per year of U.S. returns has come from Canadian dollar depreciation.
Yes. Yeah.
That's a lot. That I don't think that tailwind exists anymore.
It's a headwind now.
It's a headwind. And I think with investor portfolios, I wouldn't say, we have lots of U.S. assets, but we're looking to rebalance that away because I'm mindful that I think that dollar is going to be a real headwind over the next handful of years.
I've only got 30 seconds for this part, but I want to ask about President Trump. At the last time we spoke, you mentioned that you thought he was expending a lot of political capital on the tariffs with, the ordinary American. Do you have any thoughts? How do you think about his presidency from an investment standpoint?
They got to get off the tariff issue quick, or they're going to get, or the midterms is going to be really messy for them. So that's why, even Europe's kind of the last bastion where he was, puffing his chest and saying doing 50, and then they walked that back and they pushed that deadline forward. Like I said, I don't think he's got the time to keep this issue going. When you look at voter preference in the U.S., it's right at the bottom of what the general American voter cares about. And a lot of his base, particularly those who are really sensitive to increasing costs, are going to be hurt by higher costs. So I think like I said, I think by the end of the summer they've moved on to something else. That's why I'm worried that they're going to look at foreign assets, because they're not voters, and if someone's going to pay for this imbalance, and that's where he might turn to. You
talked a little bit about being modest overweight on equities, and so I wouldn't mind just talking about each asset and tell us where you think, and then finish up with the Canadian dollar. Tell me a bit more about within equities, what's where you're at.
So we still like financials, particularly on the deregulation. And I think I mentioned earlier, I think the tariff story is later innings, and the deregulation story hasn't even started yet. The U.S. financial system has arguably overregulated itself as a response of 2008. There's a lot of regulation that will likely lead to a release of bank capital. So we like the financials. We like industrials in terms of the focus on build in America. We've got positions in Europe as well as in adding to Canada. Again, valuations are more attractive. You get lower growth, but my argument earlier about these countries looking for investments actually should lead to higher growth profiles. So still like equities, but are a bit more mindful and probably more in a trading mode than a strategically long and just let it ride mode, if you will. On bonds, we've had a material underweight, probably one of the largest we've had in a long time. We started to take a bit of that back. It has been the right call. Bond yields have moved higher. But at these levels now, we're starting to add a bit to fixed income from cash. And then continue to build out in the private side. Infrastructure and commercial mortgages are particular areas of interest in terms of adding kind of resilience to our portfolios, where we absolutely don't believe that we're out of the woods in terms of the high levels of volatility, although April was probably the peak knock on wood,
Yeah.
volatility. But I think there's still 3.5 years left in this presidency, so there's still likely periods of market turmoil. And my point, if they do look at putting forward taxes on foreign ownership, that could be quite negative. So not getting too carried away, but trying to really maximize the diversification of our portfolios right now.
I'm just kind of mentally trying to net it out with you say about foreign ownership, but alt assets, private infrastructure, where I think all the build out happening is quite positive.
Yeah.
But is there something you have to be careful of with what you just said?
Yeah, sure. I mean, if you've got U.S. infrastructure, just like
Yeah.
anything, there is a risk that you could see taxes. Now, again, the argument is that they're going to target countries where they feel they've got unfair tax policy that's hurting the U.S. In Canada, our digital services tax has been a thorny issue.
Which we saw in this big, beautiful bill.
Yeah, and so this is where, again, Trump starts with a big position and kind of tries to negotiate from there. So I no way think that this is going to become law, but it's a risk on the horizon. It's in his mind, and so it's something to be mindful of in terms of how it would hit us.
You mentioned that you're underweight, modestly underweight the U.S. dollar. What does that mean for the Canadian dollar? Does that mean that you see it going up?
So I was on a panel last month, and this came up, and the question was, and we're looking at it inverse, so is the Canadian dollar going to sell off to 145 or rally to 130? My view is that, forget about that, is it going back to 120 or 110? 120 would be 80 cents, and 110 would be kind of low 90s over time. Afterwards, I spoke with one of the economists from another bank, and he said, the other day I got to where you're thinking. So I'm not alone in this view. I think that as the flow of capital starts to slow into the U.S. market, and if we are able to generate better growth here, and interprovincial trade is like a real easy one, right? Like it's real, and it's net right away positive to growth. It has actually major impacts to our growth. I mean, IMF's calculated for every 10% drop in interprovincial trade barriers, it would add about 20 basis points to GDP.
Wow.
So this could be a huge positive. I put those two things together, and I don't see any reason why the Canadian dollar should be this weak. So I think the CAD is going to be stronger. I think 120 would be my target over the next few years. If we, execution is everything. So there's always that risk, but if we do execute on it, then that's where I think it's going.
I'm thinking about Canadian business people. I mean, stronger, loonie, better for buying things, but then again, tariff and all that good stuff. I mean, everything kind of balances out.
But
right?
I mean, we've gotten really, as a country, we've gotten pretty sloppy about our trade. We've way over relied on the U.S. market. 73% of our exports go there. We can only send oil one way. I mean, there's a lot of things where there's a low-hanging fruit for us to better balance our trade portfolio in terms of who we trade with. This is well recognized, and as you saw today, it is the focus of the government. I also think it's interesting that Carney has sent a single letter to all his ministers, the same letter of the objectives of the government. They are laser focused on growth and improving productivity in this country. So if anything else, I think they're going to be successful there.